Hello and welcome to this Monday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, Luke Falasca is going to give us a broker update. We also have Mike Baudendistel here with us with the Rail and Intermodal update. But first, we're going to go to Zach Strickland with the carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Monday carrier update presented by PowerFleet. I'm Zach Strickland. So we've got our van outbound tender rejection index here in the green line right there, along with our van outbound tender volume index. So I'm going to break it down by mode to you today, give you a quick start to the week. In terms of what we're seeing with van outbound tender volumes, the key here is looking how much these volumes have grown versus the peak back here in March. We've actually topped peak levels from that March COVID, panic buying outbreak, et cetera. So we're really seeing some real strong numbers coming out of the van segment right now. Tender rejection rates, again, not quite as high as they were back in March. So capacity still a lot more prevalent in terms of keeping the networks in balance, et cetera. So they're doing a better job of maintaining capacity during the volume really surging well over what we were seeing this time in March. But about 14.5% right now in tender rejection rate. We topped around 20% back in March. So again, we still have time to approach it, but it looks like here over the past couple of days in the weekend, and this is not necessarily indicative of what we expect to see later in the week, but the fact that it did kind of flatten over the weekend. And again, this is not an unusual pattern to watch. You can see some of these little notches in here are indicative of weekend slowing, not as much volatility over weekends. We've talked about this in the past, but we really haven't seen the weekends have that big of an impact on the tender rejection rate here over the last couple of weeks. But now to see it kind of stall out a little bit might be an indication that we are starting to see, things moderate a tad as we approach the holiday. Again, something we do expect to see later in the week for sure, as shippers, obviously taking vacations, and they've already prepared for the week and gotten as much freight out as they can during this week before the holiday. Reefer rejections and reefer volumes. Now this is definitely kind of a swap. So reefer volumes back in March, much higher on the contracted end. A lot of that freight, grocery, commissary type freight, stuff like that, the food industry, food and beverage really taken off during that period of time. Reefer volumes this summer, they're still taken up, but they're not near as high as they were back here in March. Again, contracted reefer volumes, a lot of spot freight moving on the reefer market during the summer. So you can see those tender rejection rates, especially here over the last week or so, really taken off for reefer rejections. They're in that purple line, and they are nowhere close to where they were back in March when we saw a lot of that panic buying. So reefer volumes well below what we saw this time in March, opposite of van in that regard. Tender rejections about on par with what we would expect or what we have seen with the van side. Not as much reefer volume, but capacity still roughly similar movement there. 17.6% on the reefer rejection rate right now. So reefer volume's a little bit disproportionate to the van side right now, especially on the growth end. So looking at the rest of the country, this is our weighted rejection index. Again, this is a combination of market share value with tender rejection rate, weekly change. We've got our map over there fixed up, showing you where the most volatile markets are right now, especially the largest volume markets driving most of the tender rejection tightness in the United States right now. You can see the top 5 or so, all huge markets in the United States. Atlanta, Georgia leading the way, Dallas, Texas, Ontario, Houston, and then Harrisburg. These are all some of the largest markets in the United States, driving a lot of what we're seeing in terms of capacity tightness. So if you are operating in these markets right now, you'd certainly need to be watching out for any kind of upward rate pressure, especially as we approach the holiday. This is a traditional pattern where we see some of the larger markets start to tighten as we see supply side contraction a little bit. So some of these bigger markets, especially Ontario, Southern California, driving a lot of that, but Atlanta, Georgia, again, just driving a lot of that tightness. So in terms of the largest markets in the United States right now, I've got all the largest markets listed here in the outbound tender rejection rate index. You can see this green line right here. Ontario, California still leading the pack with a 16% tender rejection rate. You've got Dallas, Texas, and Denver, ironically, still up around 15% tender rejection rate right now. So again, the largest markets driving a lot of the tightness. And then down here in the bottom, you've got Seattle, along with Joliet in the Midwest, bringing up the back of the pack in terms of the lowest tender rejection rate. And that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi, good morning. This is Luke bringing you another broker update, and welcome to a brand new week. This is our last couple of days of June here before we roll into the 4th of July holiday, which is just around the corner. So we'll see what happens to everything as that progresses. As of right now, though, as we've continued to see volume levels have continued to surge, they've flattened out slightly over the weekend a little bit, although still holding on very strong to those numbers. The tender rejections rose a little bit on Friday when we last looked at the update, and again, same story there, have leveled out over the weekend, sitting at just under 13.5%, a very high number there. A lot of this is going to be driven largely by dry van movements there, which, as you saw earlier by Zach, volume levels are higher than where they were during that panic buying surge. So we'll see what happens here as we go into the 4th of July weekend. Traditionally, we do start to slip a little bit after the holiday, and then we kind of float into this more seasonal pattern. We'll see if that does maintain here. Time will tell. But first, let's go ahead and look at our money map here. You can see a lot of green, especially in the southeast. Notice that brighter green color is going to have a more substantial impact in tender rejection increases versus the darker forest green color is still an increase, but a little bit more of a minor or moderate increase in weekly tender rejections. The white areas are going to be relatively unchanged and still no red on the map yet. There are no markets that want to really have any sort of substantial decrease in weekly tender rejections. As of right now, it's all green. But let's focus a lot over here down in the southeast. If you're moving any freight in the southeast, you can pretty much call just about anywhere minus Mississippi. And everything is just very bright green. Strong increases in the southeast. A lot of this is going to be driven by Atlanta. We'll take a look at that. Of the top 10 largest markets in the United States by market share, Atlanta has the strongest or the greatest increase in tender rejections so far over the past week. And that is largely affecting a lot of the southeast there. Florida, bright green, Georgia, the Carolinas, Tennessee, all very, very bright green. So if you're looking for areas to call today, focused on the southeast, a lot of capacity constraints on shippers in the southeast. You'll also start to see spot market rates continue to rise in all the markets in the southeast. So let's go ahead and dive into Atlanta here. The quick reason, look at this. In orange right here, look at that orange line for a minute. That's that volume level here. We're looking pretty much since the middle of May. Volume levels are continuing to surge. They were already very, very high at the middle of June, and that orange line there you can see continues to push higher and higher on the volume levels, and tender rejections sitting at just under 15.25%, so almost 2% above the national average, which is quite substantial for a market the size of Atlanta. As far as how that's impacting rates, let's take a quick look here. We're looking at the Atlanta to Chicago dry van lane today. Both markets, Atlanta has a carrier or a sonar signal of 87, meaning carriers have pricing power quite to a significant level out of Atlanta going into Chicago. You're sending them to another strong market. So good news is you're taking carriers out of a market where they have options and sending them to another market where they have options. But pricing has increased. Week over week change is up 13.7% on this lane. So you saw a week ago we were sitting at about $1.61 a mile. That's line haul. And today we're sitting at $1.83 a mile. Again, that is line haul as well. So that's a pretty significant jump on that lane. And if you remember from that last chart, a lot of that is probably due to those tender rejections and volume levels having that sharp increase over the last couple of days. Down here in the bottom right, we'll see, again, $1.83 is the medium. You add your fuel surcharge in, you're looking at about an all-in rate of approximately $1,500 plus or minus there, just sort of depending on, you might be a little bit over, a little bit under, just depending on, if you find a carrier who's trying to get home or not. But all in all, that'll do it for today's broker update, and let's have a great end of the month.
Hello, welcome to the Rail Intermodal Update. I'm here with Mike Baudendistel, our in-house market expert for Rail Intermodal. Mike, what's the latest?
So we've been watching the FreightWaves Baltic Daily Index closely. So ocean rates have been an interesting thing to watch because the ocean carriers have cut back, greatly on capacity. It was down about 14% in the second quarter, in the third quarter about 3%, lower levels. So there's going to be some more coming on, but we're watching this closely to see how ocean rates react. So in blue, we have the rates from China to North America West. So primarily, China to say LA and Long Beach, and you've just seen how dramatically those have risen from about $1,500 a container to about $2,500 a container. So a big acceleration there. In green, we have rates on the ocean from China to the U.S. East Coast, which is about a 4-week trip versus a 2-week trip to the West Coast. And you've seen those risen also, but not have not risen as much. So when shippers are deciding to go East Coast versus West Coast, a lot of it is a decision about service versus price, because overall the consumption centers are primarily in the eastern part of the country. 80% of the population lives in the eastern time zone or the central time zone, but that does take longer. You do get some of that cost back on the road. So lately, what the market's telling us is that more shippers want that service. They're willing to pay for it. They're going through the West Coast. So this is the FreightWaves Baltic Index spread, so the spread between those two lines that we saw before, and you've seen just how dramatically that has fallen. That's basically been cut in half from about $1,200–1,300 a container to about less than $700 a container. So what that tells you is it really doesn't cost all that much more to go on the ocean all the way to the East Coast, and on a relative basis, going through the West Coast is more expensive. And we're also seeing this reflected here in intermodal rates. So most intermodal moves on a contract that no one can see other than the private parties involved in that contract. But we do have a series in Sonar for intermodal spot rates, and you've seen those rise dramatically out of LA. In blue, LA to Chicago, of course, the biggest lane in intermodal in the United States, up to $2 a mile. And then in green, LA to Dallas, up to $2.18. So intermodal is looking more attractive versus truck between LA and Dallas, but it's really accelerated in both of those instances. And putting those together, we have what we call the intermodal spread. So we're putting a lot of different data points together, intermodal rates and ocean rates, and saying, okay, well, what is the market telling us as far as which of those is more expensive? And since we've had this index, this is the lowest point it's been. So above zero, going to the East Coast is more expensive to Chicago, all in. Below zero, going through the West Coast is more expensive all in, and now it's about $2,000 a container more expensive to go through the West Coast. And what this is telling me is that shippers really want to get their goods to market quickly, either because stores are reopening or manufacturers have had to social distance and take safety measures that have reduced their throughput. So there does seem to be a backup of supplies. The fastest way to get goods to market is to go through the West Coast and get it on a rail or truck quickly to market, and that's what the market is really demanding right now.
Excellent, Mike. A lot of amazing information. Thank you so much for that update. Insightful as always. And thank you so much for tuning in. That's going to do for this edition of FreightWaves Now. Thank you so much for tuning in. We're always streaming around the clock, so check out our FreightWaves TV app on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.